Hey everyone, welcome to another episode of ADMAIL. This is Adam Bergman, founder and CEO of IRA Financial. I'm here to help you find the answers to the most frequently asked questions from my clients about self-directed retirement accounts. If you want to learn more, you can subscribe to our YouTube channel and follow us on social media. Just search IRA Financial. Hey everybody, Adam Bergman here, tax attorney, founder of IRA Financial, and welcome to another episode of ADMAIL. Today's topic, real estate IRA, episode number 3. So today's ADMAIL will focus on 3 questions surrounding using an IRA to buy real estate. I would strongly suggest you check out episodes 1 and 2, the previous 2 ADMAIL episodes, because they tackled 6 additional questions on using an IRA to buy real estate. And I'm going to do a bunch more of these episodes focusing on real estate and IRA questions because real estate is the most popular investment category for IRAs. So it's important to get as much content as I can on the questions I receive involving the use of a self-directed IRA to buy real estate. And that is the topic that makes up the majority of the questions I get. Well, not the majority, but a good chunk of the questions I get. So I figured I'm going to provide ample opportunity to get those questions presented. So without further ado, let's get started. First question is from Casey T. Casey wants to know, I have a real estate asset I own personally. Can I do a 1031 exchange with my IRA? So interesting question, Casey. A 1031 exchange, just for the folks out there who doesn't know what that is a provision of the tax code that lets you exchange one piece of property for a like-kind property, basically within 180 days, and you defer the tax on it. So let's say you bought a piece of property for $50K, and now it's worth $1 million, and you don't want to pay the tax on the difference. What you do is you say, okay, I'm going to like-kind exchange that $1 million asset for another property worth approximately $1 million. And you keep deferring the tax and keep hopefully increasing the asset you own. And then the play ultimately is you die and then your heirs get a step up in basis and you never pay tax on all the appreciation. But most people just use it as a way to defer tax on appreciated assets and still stay in the real estate game without having to pay the tax. But the nice thing with an IRA, Casey, is IRAs are like 1031 exchanges. You don't pay tax when you sell the IRA. So if you bought the IRA for 50, if your IRA bought the asset for 50K, now it's worth $1 million, all the gains would flow back to your IRA without tax. So in fact, Casey, you don't even need to do a 1031 exchange with an IRA. But to answer your question directly, no, you cannot do a 1031 with a personal asset and then combine it with an IRA asset. That's not possible. But the IRA kind of acts like a 1031 because it defers their tax, or in the case of a Roth IRA, it could wholly eliminate the tax on the asset appreciation if so long as you're over 59.5 and the Roth's been open at least 5 years. Whatever you pull out of that Roth IRA is tax-free. But whether it's a Roth IRA or a pre-tax IRA, all the growth in the account is tax free. So thank you for that question, Casey. Really good one. Second question of today's podcast is from Todd M. Todd wants to know, I have a self-directed IRA with you. Where do I report the annual income on my personal tax return? Well, Todd, happy you submitted this question, but you should know better. When you use an IRA to buy real estate, there's no tax. So you do not want to report any of the rental income on your personal tax return. Please, please, I pray you have not done this, okay? And if you have, call me because you're going to want to amend your returns. Because if you generate rental income or gains in an IRA, even if it's an IRA LLC where the LLC owns the property, Todd, you don't own the asset. Your IRA does. So you don't have to report the income on your personal tax return, right? That's the whole point of using the IRA is you defer the tax till you take a distribution, or if you have a Roth IRA, you can eliminate the tax on the distribution. So please, please do not report any income and gains from an IRA or an IRA LLC investment on your 1040. No, 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 do not do that. even if you have something called UBIT, unrelated business income tax, which we're actually going to get to that, to another question involving UBIT in a minute. That would go on a 990T. That would not even go on your personal tax return. The only time you report income or income on your personal tax return associated with an IRA is if you take a taxable distribution or you do a Roth conversion. But you do not report the rental income owned by your IRA on your 1040. Remember, your IRA owns the asset, or the LLC owns the asset, not you, Todd, individually. So if you've done so already, contact us. We're going to help you amend your return. If you haven't done so already, I'm happy we got this question to you, Todd. Hopefully you're listening or watching on YouTube. Third, final question of today's podcast from Xavier H. Xavier wants to know, I want to invest in a hotel with my self-directed IRA, but keep reading about a tax called UBTI that could apply for real estate. Would this UBTI apply to a hotel investment? So great question. I brought up UBTI in a previous question from Todd. So UBTI, or unrelated business taxable income, unrelated business income tax, whatever you call it, it's a ugly four-letter word, which I've mentioned, hundreds of times on previous videos, podcasts, blogs. It's a tax that really shouldn't even apply to IRAs. It applies to charities like the Red Cross, but since IRAs are taxed like charities, meaning they're not taxed, they're exempt from tax under 501, they are subject to this tax known as UBIT, unrelated business income tax. For a charity, for example, if there's a hospital and they sell, I don't know, TV screens or computers, clearly the sale of computers is unrelated to its exempt purpose of saving and healing people. So the IRS will tax the income and gains from that non-related or unrelated business at a maximum trust tax rate of 37%. IRAs don't have an exempt purpose, right? The whole purpose of an IRA is to save and grow as much as possible. So the word unrelated doesn't even apply to IRAs. It's just not relevant. Unfortunately, because an IRA is taxed as a charity, since they're both tax exempt, IRAs get stuck into this bucket of UBIT, even though that probably wasn't the intent. Nevertheless, the rules suggest that if an IRA invests in these three types of transactions, UBIT could apply. Number one, invest in a real estate asset with leverage, meaning whether it's a real estate fund or use your IRA to buy real estate, if you use a non-recourse loan to help purchase the asset, a non-recourse loan is a loan you do not personally guarantee. The reason it must be non-guaranteed is 4975C does not allow an IRA owner to personally guarantee an obligation of their IRA. So that's why the loan has to be non-recourse. So non-recourse loan to buy real estate, one way to trigger UBIT. Non-recourse loan to buy stocks or margin, another way to trigger UBIT. Third, invest in an active trader business through a pass-through entity like an LLC. So, Xavier, to get to your question, a hotel is a business. If you invest in a house, even an investment in a apartment building, that is not a business. That's a rental asset. A hotel is a business. The difference between a hotel and a rental apartment is a hotel, you're providing additional service like maid service or other type of services that does not encounter the traditional rental real estate, common example. So in the case of a hotel, because there's additional service, hotels are treated as businesses, where if you buy a semi-detached, a condo, house, even a multifamily apartment complex, for IRA purposes, assuming that there's no leverage, it's not a business. It's still rental income. A hotel, you're not getting rental income. You're getting business income. So because the hotel is treated as a business, if your IRA invests in a hotel through a pass-through entity, such as an LLC, then a percentage of the income could be subject to UBTI tax, which can go as high as 37%. Now, if the hotel is owned through a corporation, C Corp, the C Corp would block the application of the UBTI tax, and therefore you would just pay 21% corporate tax, but there would not be any UBTI tax because the corporation blocks the UBIT tax. That's why if you buy Tesla or Apple stock, you don't have to deal with UBIT in your IRA because almost every publicly traded company, including REITs, are corporations treated as corps, a box. Whereas an LLC, think of it as like a funnel. There's no entity level tax. So that's why the UBTI tax come, and it is imposed on the flow through of income from the pass-through business. If your hotels operate through a C Corp, meaning the C Corp owns the hotel, no UBIT, pay corporate tax, and then the tax-free dividend to the IRA, but no UBIT tax. If your IRA owns the hotel through an LLC, now let's say your IRA owns 5%, 5% of the net income could be subject to UBIT. If there is no net income or net income less than $1,000, then no UBIT. But more than $1,000, and once you get to around 15K, you're in the highest trust income tax bracket, which is super low, 15K, which is 37%. So as I mentioned, Xavier, the UBIT is an ugly 4-letter word. There's ways to eliminate it through the C Corp blocker. If you get a tax distribution, you can minimize the scope of it, or the impact of it, but it would apply. It is frustrating because it probably should not apply to IRAs, but unfortunately it does. So just remember, a hotel is a business, and if you owned condo or multifamily, it probably treated more as passive, as rental income, not subject to UBIT. Although if there was leverage associated with that real estate asset, then even though it's not treated as a business, the use of the leverage would trigger the UBIT tax on the leverage portion, not necessarily the entirety of the business income. So more to come on UBIT. I've done a lot of videos and podcasts and blogs on it. So if you are interested in learning more about UBIT, there is so much content on the IRA Financial YouTube channel. You can check out our menu of podcasts. If you're listening to this on Apple, Spotify, just look through past episodes. And I've done a lot of episodes on the UBIT subject or UBTI, so you can dive into more information and make sure you understand it. If you don't understand it, even after all that content, don't sweat it. Just contact us. You can always call us, you can chat us, you can email us, hit us up on social media. We will happily answer any questions. Even if you're not our client, the key is making sure you have all the necessary information so you can become a better, smarter, and more successful self-directed IRA investor. So that's it for today's podcast. Hope you guys enjoyed the content. Really important topic. Appreciate you guys hanging out with me today. And I hope to see everyone again next week. Take care and have a great day. Thanks.